All right, here we go. The difference between stocks and options. Well, in front of you, have a chart of American Eagle, and I could have chosen any chart, but I just like the stock because of this price. And so when you look at stock trading, you see I just drew a line. In stock trading, the only thing you can do is buy or sell shares of stocks. It's very simple. It's very straightforward. If you buy a share, we call that being long. If you sell a share, we call that being short. It's a little technical, but if you ever talk with another stock person or hear it on TV, I kind of want you to understand the terminology. Some of the benefits of buying stock is that you can buy as many or as little shares as you want. I told you in the last lesson that each option contract represents 100 shares of stock. Well, when you go out and buy or sell stock, you can buy 1, 10, 25, completely up to you. Whereas when you're buying an options contract, you are potentially buying or selling 100 shares. You are controlling 100 shares. So going forward, I will always be using 100 shares as the baseline, just because I want to compare apples to apples. But know that when you just buy stock, you can actually control or say how many shares of stock you actually want. Another benefit of buying stock is that you can own stock as long as you want. There is no expiration. With options, you will have to remember that we said the contract has an expiration date. 1 year, 1 day, 1 month. We just never know. So this is a benefit because if you're buying a strong company and they had a bad month or a bad year, the stock can actually go lower than when you originally bought it, and you can just hold it until the value comes back on what you paid, and then even it goes higher and you actually gain a profit from that. The last benefit of owning stock is that some companies pay dividends. And what that is basically they say, because you have invested in us and are trusting us with your money every month or every 3 months, we will take some of our profits and pay it back to you, the stockholders, or they call them shareholders. This can offset some of the losses of the stock if the price goes against you. And also companies that pay dividends are usually more stable companies. This is not a blanket statement at all because there are companies that pay dividends and they have gone out of business. They've done this, that, and the other. So it's not a blanket statement, but it's just a generalization. Most companies that pay dividends don't go under. Now let's talk about leverage. Leverage can be good or bad. It just really depends on how you use it. Think about this teeter-tot. Kids are able to lift the weight of their friends just because they are using leverage. In the stock world, what this means for us, or translate to, is the ability to have a position of greater value than what we are actually monetarily investing, what dollars we're putting in, we actually can control more. Like in our example from lesson 1, George had control or leverage to own stocks that had a $2,000 value, but it only cost him $100 out of pocket. This is the power of leverage, and that is one benefit of using options versus buying the stock outright. One of the great benefits of options contract is the fact that it has defined risk. When you buy an option contract, you can only lose what you paid for that contract. So the stock market is open every day from 9:30 a.m. to 4 p.m. Eastern Standard Time, except for holidays and special days. But it also has pre-market and post-market hours. And so the institutions can move the market when people like me and you can't even get in, so to speak. And also you have global events and economic events. Imagine that the CEO came out and said that they lost a contract. Well, that stock can move pre-market. Or let's say in the case of pharmacy, we've had it before where a pharmaceutical drug trial that was out, the FDA said that it didn't pass the clinical trials, and that stock just dropped, and you cannot get out of that stock. And so with an options contract, the most you can lose is what you paid for that contract. So let's look at our example. George pays $100 for his option contract, and he has the right to own it at $20, which would be $2,000. So if he only owned the stock and he paid $2,000 and that company went out of business, then George would lose his whole $2,000. It would just be gone. Nothing he could do about it. But if he only owned the option, then the most he could lose is $100. And so that gives him safety. That gives him a little bit of covering, a little bit of cushion, gives him peace of mind. He can sleep every single night knowing that he has a max loss and it's only the $100 that he invested in the options contract. So let's talk about how simple options can be. I have here a tablet, and it can be as simple as 2 plus 2 equals 4, or 15 minus 3 equals 12. That's how simple options can be. You can buy and you can sell, just like you can do with the stock. So instead of actually buying the stock, you can still just use leverage to control the stock. And you can buy an option, and as the stock goes up in value, your option goes up in value. For the most part, there are some nuances, some other things we have to talk about, but in just a simple call, usually when stock goes up in value. And if you can buy a put, it's the same thing as if you sold short the stock. As the stock goes down, the put gains value. So I know that gets a little bit confusing, but we will definitely talk about that, like I said, in later slides. But that's so simple. You just spend money, you invest money, and if the stock goes in your favor, the option will gain value. Now, we can try and get a little bit more complex. And so I have this picture of a mathematical formula. It's Greek to me, but just like geometry and trigonometry and calculus can become Greek to a lot of us, we can learn it, the ability to. And there's so many complex things that we can do with these mathematical formulas if we know how to use them. And that is the same way with options. Instead of just buying and selling, you can have a position that gains value if the stock goes up, if the stock goes down. You can have a position that gains value if the stock just stays in a range. If it stays between a dollar point, if it stays between $5 and $10, you can still make money. You can make money if the stock goes nowhere. You buy it today and the stock's at $10, and 30 days later, the stock's still at $10. You can still make money. And so it's just so many different complex ways that you can actually use and utilize options to benefit yourself. And that is what we're going to talk about in some of the later lessons and later slides. And so don't let this confuse you. I just want to kind of let you know how complex it can become over time. But the lessons that we're going to teach you are not going to be that complex, and we're not going to go and dive into all of those different intricate strategies. We're going to give you all the easy, simple strategies that a lot of people use. And over time, we'll teach you more things.